Welcome back. Well, the IPO rush is back in the markets, in the primary market, and that too at a time when markets have largely been booming. Of course, let's not take into account what kind of a day we've had today. Now, I think the first IPO that got hit really badly in terms of timing was the SBI Cards, one prominent one this year, big mega IPO in the month of March. Since then, there has been a bit of a lag and everything very quiet when we were still figuring out what's happening with the pandemic. Markets have been rising consistently at the same time. Then we've had the stellar debut from Happiest Minds, from Root, three major ones this week as well. Let's try and get a sense of what really is happening in the IPO market, why this rush, and what it means for investors. And joining me to do that now is S Ramesh, Managing Director and CEO of Kotak Investment Banking, and Pranav, Haldea, MD of Prime Database. Welcome to both of you, and thank you for speaking with us today. Mr. Ramesh, let me get your perspective first of all on why you think the IPO market is buzzing again. Is it a lot of retail investors who've entered at this time wondering what's happening and looking for fresh scripts really to put their money in?
So it would be right to say that at the current moment and for some time now, there has been a bit of a gold rush from investors, particularly the retail investors, towards IPOs. It's not in the normal course that we see close to 1.5 million and 2 million applications coming into relatively modest price, smaller issues. So we've seen them. But if you just go a little back, there was a biotech company which made its IPO, I think, some time back, which also got an excellent response. So in general, you find that the market has been attracting IPOs. You talked about it. So all of that is correct. But maybe it may be a lengthy answer, but if I just want to give a little perspective to why we are seeing some of this happening. So there was a COVID scare when markets melted, but as the markets sort of accepted that COVID will be there, this will be a long drawn affair, and markets stabilized. You saw that the secondary market bounced back, and you saw fundraising through QIPs from the banks. You saw rights issuances from the NBFCs. And you saw a lot of block trades from promoters to deleverage, etc., which gave stability to the companies and to the markets. And on the back of that, which is typically the case, you've started now the IPOs which were filed in the past now slowly come to the market. And the good news is that in most of these QIPs, rights issues, and the IPOs, investors are in the money. So it's a good situation. But having said that, I will just bring in a small word of caution. While the frenzy is not there, I think this kind of rush has not been there for a long while before. So we have to be optimistic, but we have to be cautious at the same time. I'm particularly talking in the context of retail investors.
Mr. Ramesh, tell me what happens when you have a bad day like you've had today, a manic Monday. Global markets are in a world of pain. There's likely to be a spillover tomorrow. I don't know, the rest of this week might not be so great. Do you think this will dampen spirits at a very crucial time when you have CAMS, Chemcon, Angel, all of these opened up today and opened this week?
So if you saw the response for the CAMS IPO today, at least for a long time in my career, I haven't seen an IPO retail bucket getting subscribed on the first day, right? So I think that tells you that the market investors, the retail investors in particular, have not looked and have not allowed any of this to impact them. Having said that, I think we are seeing the US markets are down. You had a debate on your show a few minutes back about some of the negative sentiments that are hitting the Monday market of today. My judgment is that the frenzy is so strong that this may not have an impact, at least short term, on the subscription. These IPOs are strong, they're well placed, and they should garner good response. Now, what will happen to IPOs in the future will depend upon the market sentiments that occur at the time these IPOs are open. And the jury is still out whether this is a little bit knee jerk or this is there for some more sustenance. So based on that, I think there may be a little impact on some of the response. But in general, I'm seeing a pretty good momentum both from institutional and retail investors for new issuances.
Well, I think the retail investors' excitement is understandable. Look at your other sources of investment right now. Some are off mutual funds. Your interest rates are just going southwards. And what do? You've had a taste of the markets, and now these IPOs are coming along. Having said that, Pranav Haldea, give me a quick SWOT analysis on the three this week which are open: CAMS, Chemcon, and Angel Broking. What do you like?
Well, to answer your first question, I think IPOs in fact are one of the most risky asset class. So you spoke of mutual fund, you spoke of deposits. Even in comparison to already listed companies in the secondary market, IPO represents a highly risky investment. So retail investors need to always be exceptionally cautious while investing into an IPO. I would not like to give any commentary specific to any particular company, but coming to the valuation and the sort of response that you've seen to these two recent IPOs, looking back over the last 15 to 20 years, what one really sees is that at the beginning of the IPO cycle, you typically have companies coming in at good valuations, good companies coming at good valuations. And as this IPO cycle continues, you see valuations getting more and more expensive. Now, because of the pandemic and all the reasons Mr. Ramesh also spoke about, and this being just the initial few IPOs in this cycle, you are seeing these companies offering their shares at reasonable valuations, and which is why you've seen good oversubscription numbers as well as good listing gains. Going forward, I think retail investors need to continue to be cautious in terms of the offerings which are there and the valuations which are on offer.
Let me talk about the kind of listing gains then, Pranav. You have, made it very clear that there should be caution when retail investors come in, but people are looking at listing gains, they're looking at Rosario, they're looking, at Happiest Minds, they're looking at Root, and they're like, wow, I want to get my hands on whatever is going on here. So having said that, what would you say about listing gains? Because most listing gains don't really sustain, do they?
Is that question to me?
Yes, Pranav, that question's for you.
Yes. So in fact, you would have seen today itself, we'd come out with some research which looked at all the IPOs of the last 5 years, and looked at the ones which gave listing gains of more than 40%. And the track record shows that if one looks at now, more than 50% of them are actually trading below their issue price. At the same time, I personally do think that it's a bit unfair to look at an IPO 5 years later to evaluate its performance, because once the IPO happens and the company gets listed, it is like any other secondary market company which is listed on the stock exchanges, which will be impacted by its own financial performance, by the sectoral performance, as well as what's happening in the broader economy. So it is a bit unfair to look at IPOs 5 years hence and say that they performed well versus they did.
Mr. Ramesh, I don't know how comfortable you are talking about which of the IPOs which are out there right now you like, but can you give us a general guideline for investors who are out there and watching this on what they should look out for? Would a very popular IPO subscribed several times over, of course it would depend on the ticket size of the issue, would that be an indicator if it's good? What are the basic factors that you would look out for?
This is a complex question and cannot be answered in a minute. But I will just venture to give some broad parameters that particularly retail investors should focus on. See, I think the good news is that the Indian primary market, particularly the IPO market, has got a good architecture, because you have the QIPs or the institutional people who actually, in a way lead the pricing and the demand for the IPO. The retail investors are able to watch that feedback, that reaction, and are able to invest at what we call as cutoff price. So therefore, one thing they should watch for is what has been the institutional response. And nowadays, there is market data available about what quality of investors have come into anchors, etc. So this is one pointer. The second pointer is the promoter and the track record. So if you saw, for example, Happy Minds, I think there was a lot of weightage given to the credibility of the promoter, right? So the promoter in these kind of instances is important. And wherever they are able to analyze simple profitability and understand that this is a profitable company, I think that is one more plus factor in the IPO. Let me go to the next question, which is a little more complex. When retail investors come into an IPO, it is imperative and critical that they also have an exit plan, because something that has doubled in this form with 2 IPOs, at least from our experience, it shows that you should not expect this from every IPO. That's not sustainable. And therefore, every retail investor has to be cautious that, look, he has made an investment. If it is for an IPO listing gain, he makes that reasonable return, he must quickly call his broker and exit discount. As long as this form of broad discipline is there, I think for some time, with the right quality of issuances, retail investors can look forward to making reasonable return from primary markets.
Well, be cautious, be safe. Not everything that glitters is gold, I think, should be the thumb rule, especially in the IPO market. But there's no denying, like the gold rush, the IPO rush is back. Let's see how markets sustain and whether they can sustain that enthusiasm. Thank you so much, S Ramesh and Pranav Haldea, for joining us.